The 1975 American economic recession was a classic example of what happens when an economy suddenly loses supply of a critical commodity. We can all agree that the future of crypto is very uncertain as bears maintain control and lead markets lower into what is shaping up to be a brutal American recession and potentially global recession. So in this series on US recessions, I'm going to look back into history to explore what caused the economic declines, how the economy eventually recovered, and most importantly, what assets remained resilient through those harsh winters. And I'm going to be dropping some heavy knowledge bombs in this episode on the 1975 recession, so go ahead and get locked and loaded. But before I do, make sure that you smash that like button. Make sure you hit subscribe, boom, bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Now, let's go see if the future is going to repeat what happened in the past. The 1975 recession took place from 1973 through 1975 and was the result of several sudden bearish factors. But before we get too far along, let me tell you what a recession even is. A recession is a significant, widespread, and prolonged downturn in economic activity. A common rule of thumb is that 2 consecutive quarters of negative gross domestic product, or GDP, growth means a recession is on. In 2022, a recession was not actually confirmed or declared, even though there were 2 consecutive quarters of negative GDP. And the reasoning and bias behind it was that's what the media says a recession is, not the government. So although I don't technically necessarily agree with the fact that there wasn't a quote-unquote recession in 2022, the reason given was that the labor market was too healthy for it to fully qualify. This specific detail within the definition will become important towards the end of this series, but for now we can bury our heads in the past where a recession could have just be a recession. In 1973, there was a sharp increase in oil prices due to the oil embargo by Arab producers, a decline in military spending following the end of the Vietnam War, and an overall slowdown in the global economy. Now, during the 1973 Arab-Israeli War, Arab members of the Organization of Petroleum Exporting Companies, or OPEC, imposed the embargo against the United States. They basically said they were not going to sell oil to the US anymore. Great. This was in retaliation for Nixon's administration's decision to give the Israeli army supplies to continue fighting the war against the Arabs. The embargo that started in 1973 caused the price of oil to absolutely melt faces with a 1,014% increase that peaked in 1980. At today's prices, the cost per barrel rose 280% from $3.50 in mid-1973 all the way up to about $13.90 by late 1976. That's a pretty steep incline. In today's prices, that would be the same percentage increase as oil, moving from where it is trading at the time of recording of this video, and that is $75 per barrel, all the way up to $280 per barrel. I'd be riding a bike a hell of a lot more if that were to actually happen. In the United States, this created an extremely volatile economic environment with sky-high inflation that increased over 347% over 21 months, peaking at 12.1% in late 1974. Then unemployment rates followed and they rose to 8% but did not come back down to the Fed's target rate of 4% until 24 years later. The stock market took a massive hit, obviously. Millions of ordinary people were forced to sell their investments to pay for the ever-growing cost of living. The Dow Jones Industrial Average shed more than 45%, but that did not happen suddenly with a quick V-shaped recovery. On the contrary, that 45% drawdown dragged out from the peak in early 1973 down to the bottom in late 1974. Almost 2 full years. But despite the challenging economic conditions, there were some assets that performed well during that 1975 recession. Want to know what they are? Gold actually saw significant price increases due to its status as a safe haven asset. Gold mining stocks also did well during this time as investors looked for ways to protect their wealth. And when I say well, I mean really well. Gold spot prices added 207% from the beginning of the embargo, where it was trading around $63, up to the peak in 1974, with an ounce of gold going for over $195. And real estate was another asset class that actually performed well during the 1975 recession. Surprise, surprise. While the overall housing market may have actually been sluggish, certain sectors such as apartment buildings and commercial property saw strong demand as investors sought out stable income generating assets. Makes sense. But in terms of bonds, long-term government bonds were a popular choice for investors looking for a safe place to store their money during that recession. And they were seen as a safer alternative to stocks, which were more vulnerable to market fluctuations. Now, there were several factors that actually contributed to the recovery of the American economy following that 1975 recession. One key factor was the implementation of monetary and fiscal policies by the US government and the Federal Reserve. Regulation? Surprise, surprise. These policies, which included lowering interest rates and increasing government spending, helped to stimulate economic growth and boost demand. Back then, the government was spending much more conservatively, which sounds a little bit different from the potentially rubber-stamped Congress that we have today. Another factor that played a role in the recovery was the strong performance of the exporting sector. As the global economy began to improve, American exports saw strong demand, helping to drive economic growth. Finally, the energy crisis of the 1970s eventually came to an end, with oil prices returning to normal levels. And maybe America finally figured out that we have the most oil over any other country in the world. So this helped to obviously ease some of the inflationary pressures that had weighed on the economy during the recession, but inflation did not see a sub 5% rate until late 1982. And inflation is the one that you don't want to mess with. Overall, the recovery from the 1975 recession was slow but steady, with the economy returning to more normal levels of growth by the late 1970s. And today we have a lot to be grateful for. Mostly the fact that the price of oil did not shoot up 200+% out of nowhere. But what can we learn from that 1975 recession? One key lesson is the importance of diversification in times of economic uncertainty. By spreading your investments across different asset classes, you can help to mitigate the risks associated with any one particular market. And having your money invested in gold and real estate would have actually been the move back then, but it may not necessarily be the move now. Gold is certainly still looking under, but real estate has experienced a massive buyer's market that pushed home prices higher. So I would revert back to the apartment complexes and the commercial properties of the world. You can certainly find deals out there in the market, especially in commercial real estate. Not all recessions are the same, and I would argue that this time around, real estate is going to be one of the big asset classes to stay away from, at least residential. Here is why I believe that this time is different. In the early months of the pandemic, there was a slowdown in the housing market as people were hesitant to buy or sell homes due to restrictions on in-person showings and open houses. This resulted in a decline in home sales and a slowdown in price appreciation. However, as the pandemic progressed and it became clear that we were staying locked up for a long time, people living in large cities made the decision to seek new residences in less populated and more stable parts of the United States. Many real estate transactions are now being conducted remotely, with virtual tours and online paperwork becoming very common. So the pandemic actually accelerated the trend towards low-friction online platforms to search for and buy homes. Couple that with the low interest rates from the Fed, that also created a friendly environment for buyers, and if you add in a shift to remote work, that people are spending more time indoors and wanting more space, you get higher prices. Oh, and also remember that it takes construction workers to build new homes, and when all those workers were forced into lockdown, that caused a big delay in the supply of new homes. Lower supply, higher prices. A global pandemic and the extreme overspending of a government is what was fueling the current unofficial recession that we are in. Not a sudden dramatic spike in oil prices like in the mid-1970s, so definitely take that into account. In the next episode of the series, we're going to explore the 1982 recession and see what we can learn from that as well. But that's all I have for this episode. Let me know what you think down in the comments section. What are the safe havens that you see coming during this global potential recession? And if you like content like this, make sure you show up to the next video and make sure that you smash that like button. Make sure you hit subscribe, boom, bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Thank you so much for showing up to this video. I will see you in the next one. Have a good day, everyone.